Hello and welcome to another session of the My Solo 401k Financial YouTube webinar series. We're about to get started. Please feel free to chat over questions or topics that you wish to discuss. We've got a number of slides that we wanted to bring and share on a prepared topic here. That topic is how much income do I need to maximize solo 401k contributions? Today's session is specifically geared towards businesses that are taxed as a partnership, multi-member LLC, those individuals that are filing, for example, a 1065 partnership tax return. We want to dig into the good question we often get, which is how much income do I need to be able to maximize solo 401k contributions? So with that stated, the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor is a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So if you're on the YouTube channel, we would encourage you to subscribe, or if you can go to YouTube and subscribe. This is a series of webinars that we're doing specifically on how much income I need to be able to maximize contributions. We previously held sessions for businesses that are taxed as an S Corp or a C Corp, or as well as another session for businesses taxed as a sole proprietorship or a single member LLC. Again, today's session is geared towards businesses that are taxed as partnerships, multi-member LLCs. But on the horizon is we're looking to host a deep dive session this Friday regarding solo 401k loans. Last week, we held a session regarding the solo 401k establishment process. So by subscribing, you get notifications of all these sessions. You get access to the recordings. Another popular topic right now is the fact that Vanguard announced that they're exiting the solo 401k business. So we have tremendous resources on our website, including a deep dive webinar that we hosted regarding options and impacts for existing Vanguard solo 401k account holders. And then, of course, we've got a number of other topics on the docket. So this is just an idea, just a sample of the sessions that we host. So we always like to focus on educational content. So as far as today's topic, here's what we're going to talk about. Again, it's how much self-employment income do I need in order to be able to maximize solo 401k contributions. We want to, of course, lay the foundation with solo 401k basics like eligibility, top use cases. We want to understand the contribution rules. And then once we've laid that foundation, really go through different scenarios and examples to illustrate and answer that question, because some folks have different objectives in mind. So the answer is going to vary depending on what someone means by how much self-employment income do I need to maximize contributions. And then we want to go over some bonus content, which is the $1,500 solo 401k tax credit. So as always, we go live every day in our community, mysolo401k.net/my-community. It's always free to join. All are welcome. We host office hour Q&A style Zoom calls at 1 p.m. Pacific, 4 p.m. Eastern. So again, it's all are welcome. It's free to join. It's a great way to learn, to ask questions, to hear what other folks are asking. You can also do it 24/7 on our forums. We've got a number of great forum threads going. So it's a great place to jump in again and ask questions and learn. And then finally, we have our library of hundreds of videos and webinars. So it's just chock full of educational content. So as far as laying that foundation and starting with the basics, number one is, okay, is who's eligible to set up a solo 401k plan? Well, the solo 401k plan is for an owner-only business with no full-time W-2 employees. So think like an independent contractor, a solo practicing professional like an attorney or CPA. Some of the top eligibility considerations would be, okay, do I need a separate entity like an LLC or an S Corp? The answer is no. You can be a sole proprietor. You don't need to have a formal legal entity. Now, the fact that you might have a formal legal entity is not going to prevent or preclude you from being able to set up a solo 401k, but it's not a necessary requirement. What is necessary is to report earned self-employment income on your taxes. So for a business that's taxed as a sole proprietor, that's going to be on Schedule C. For a business that's taxed as a partnership, That would be on line 14 of the K-1 that the individual receives from that partnership. Or for a business that's taxed as an S Corp or a C Corp, that would be W-2 wages. Ultimately, you need to be able to show that you have earned self-employment income. And the way that I think about it, that is that a 401k is for someone who works, and a solo 401k is for a self-employed person. But you still have that notion, that requirement that you have that earned income, as opposed to investment income that someone might report, for example, on Schedule E of their 1040. Now, there is no minimum amount of earned self-employment income that you need to report in order to be eligible to set up a plan. But as we'll see, as we go through the different scenarios to answer the question of how much income I need in order to be eligible or in order to maximize solo 401k contributions, one can't save more than they earn. So if you don't have a relatively high amount of earned self-employment income, you're not going to be able to save more than that self-employment compensation. So you wouldn't be able to save a relatively high amount. Now, a spouse or business partner may also participate in the plan as long as the spouse or business partner is reporting their own earned self-employment income, such as their own Schedule C or their own K-1 or their own W-2, depending on how the business is taxed. Someone may set up a solo 401k even if they have a W-2 job, even if they participate in their W-2 employer-sponsored plan. Again, as long as they've got that separate earned self-employment income. Now, let's touch on at a high level some of the top use cases, which really relates to and maps to the top benefits. So here we're highlighting some of the top benefits quickly, which is the ability to contribute to the plan. A solo 401k has the highest contribution limits for any defined contribution plan. Our plan also allows for alternative investments. We help clients set up accounts where they have checkbook control so they can act quickly to take advantage of investment opportunities. And this is true alternative investments like notes and real estate and crypto. The ability to take a 401k participant loan where the individual can literally take money out of their 401k account and it's not considered to be a taxable distribution. It could be for an emergency purpose or really any purpose whatsoever. The requirement is that it just needs to be documented as a loan and paid back according to the loan payment schedule, which we handle the loan documentation requirements as part of our service for no additional charge. Now, just to really highlight some of these benefits, we'll look at different use cases that we're seeing. So one would be the frugal investor, right? Someone who's really trying to be as efficient as possible when it comes to costs. So our plan, as we'll look at more closely later in the presentation, would make the individual who sets it up eligible to claim a $1,500 tax credit. So that means that the net cost over the first 7 years is more than covered by that $1,500 tax credit. The net cost is $0 over those first 7 years. Moreover, the individual can pay our fees with non-retirement money to really preserve their account balance. Another top use case would be the Roth maximizer. So someone who's really looking to maximize the amount of funds in their Roth solo 401k. One way to get money into the Roth solo 401k would be contributions. And our plan allows for not only Roth employee, but also Roth employer, as well as voluntary after tax, which is how one makes mega backdoor Roth contributions. So ultimately, this individual could end up contributing, for example, for 2024, $69,000 or even $76,500 if they're 50 or older, with those funds ultimately ending up in their Roth account. The second way that someone could get money into their Roth solo 401k would be an in-plan conversion. This is where the person takes funds that are already in their solo 401k, or it could be in an IRA that's in a pre-tax status, or it could be in a former employer plan that they roll over to their pre-tax solo 401k account. And our plan would allow for an in-plan conversion where they convert those funds from the pre-tax solo 401k account to the Roth solo 401k account. Would be taxable in the year of the conversion, but a lot of our clients, they may be advised by their tax advisor, by their financial planner, to do those in-plan conversions, say when their income is low or relatively low, to really maximize the funds that are in the Roth account so that going forward, they've got that potential for tax-free growth. A third scenario or use case would be the large account holder. So this is with somebody who maybe has more than that does have more than $250,000 in value of their solo 401k account, where they need to file a 5500 EZ. So we handle 5500EZ preparation as well as filing under the electronic filing system as an optional free service. In other words, no additional charge. A fourth use case would be the alternative investor. So this would be someone that's really looking to not only invest in typical brokerage type investments, which of course you can do with our plan, right? We help clients set up accounts at many different brokerages like Fidelity and Schwab, where they're able to invest in a wide range of investments like stocks, bonds, mutual funds, ETFs, etc. But also to invest in true alternative investments such as real estate, private placements, crypto. And as part of the setup process, we're helping clients open up accounts where they have checkbook control. And based on feedback and experience, that can be instrumental because now that individual can act quickly to take advantage of investment opportunities. Moreover, we're answering questions every day in terms of educating our clients when it comes to the solo 401k investment rules. For example, how do I invest solo 401k funds in real estate? How do I invest solo 401k funds in crypto? Lastly, in terms of the use case, would be the rainy day investor. So this highlights the fact that our plan allows the individual to take a solo 401k loan. So, right, this could be for an emergency purpose or really any purpose whatsoever. We handle the loan documentation requirements as part of our service for no additional charge. It's not going to be taxable when the individual takes a solo 401k loan, as long as it's documented as a loan, paid back according to the terms, etc. So those terms would be they could borrow up to 50% of the balance, not to exceed $50,000, and that's per participant. So if it's a husband and wife that are both working in the same business and both participating in the solo 401k, if each individual has $100,000 in account value of their solo 401k, each person can borrow $50,000. Now that's going to have to be paid back in equal payments, monthly or quarterly. It's up to the solo 401k owner. Equal payments of principal and interest. The interest is going to be prime plus 1%, or it could be a CD rate plus 2%, with those payments spread out over a 5-year term. So now that we've laid the basics down in terms of eligibility, use cases, now let's start to build on that and talk about the solo 401k contribution limits. And once we understand those limits, then we can really answer the question of how much income I would need in order to be able to maximize solo 401k contributions. So whenever we talk about the solo 401k contributions, it's good to recognize that the ability to contribute to the plan is based on different factors. One factor we've talked about, which is the self-employment income, right? The whole notion that you can't save more than you earn. Another factor is your age. A third factor would be whether or not you're participating in another plan, like a day job plan. And then finally, the type of contribution that you're looking to make, right? Whether it's employee versus employer, pre-tax, Roth, or after-tax. So as I mentioned before, the solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because the person can make both employee and employer. So as we'll see, as we look at the different scenarios, some folks are making both. Many folks are making both. But let's start to go through these different factors. So number one, self-employment income. So for a business that is taxed as a partnership, self-employment income is going to be line 14 of their K-1 less 1/2 of the self-employment tax. So you have to do a pre-calculation to determine self-employment compensation. We help clients, we educate them on, okay, how that calculation works in their specific scenario. We have a calculator on our website that will also run the numbers for them. Now, it's important to keep in mind that the purpose of the solo 401k is for the person to save self-employed income, earn self-employment income. So that means they're not going to be able to use W-2 wages that they might have from other sources, like a day job. It also means they cannot use investment income, right? Like income that's reported on Schedule E of their taxes. Now, this is a great slide because it really highlights that pre-calculation, right? So you start with line 14, code A, the amount that's reported there on line 14 of the K-1, less 1/2 of the self-employment tax. Once you have that figure, that is your self-employment compensation. So once you know that, now you can really start to figure out, okay, how much can I contribute to the different buckets? So the first bucket we'll talk about is the employee contribution limit. Employee contributions are also referred to as salary deferrals. That's a synonym. So for a business that's taxed as a partnership, right, where the income is reported on a 1065, the solo 401k owner receives a K-1 from the partnership. they have to do that pre-calculation, line 14 of the K-1 less 1/2 of the self-employment tax. Once they've determined that amount, they're going to be able to contribute 100% dollar for dollar of their self-employment compensation as an employee contribution, not to exceed $22,500 for 2023, plus an additional $7,500 if they're 50 or older. For 2024, the limit went up to $23,000 plus an additional $7,500 or $30,500 if they're age 50 or older. Now, this employee limit applies at the employee level. So if the individual is making contributions to another plan, like a day job plan, they have to aggregate. So if they've already maxed out their employee contributions to their day job plan, they're not going to be able to contribute any more employee contributions to the solo 401k. Now, one exception to that rule would be if those contributions were made to a 457 governmental plan, in which case those contributions do not have to be aggregated. So this employee contribution could be contributed as a pre-tax contribution to reduce their taxable income for the year for which the contribution is made. Or if the plan allows it, like ours does, that employee contribution could be made as a Roth contribution. So it's not going to reduce the taxable income for the year for which the contribution is being made, but you have that potential for tax-free growth like any Roth account. Now, if you're going to make the contribution as a Roth contribution, it needs to be deposited into a separate sub-account. And as part of the onboarding process for our clients, we're asking them, oh, are you looking to make Roth contributions, et cetera? So we can help them open up the requisite number of accounts at the bank or brokerage of choice. So the second type we're going to talk about are employer contributions. These are also referred to as profit-sharing contributions. That would be a synonym. So for a business that's taxed as a partnership, right, a multi-member LLC taxed as a partnership with the income reported on a partnership tax return 1065 and K-1s issued to the partners, remember, you got to first determine self-employment compensation, where you take line 14 of the K-1 less 1/2 of the self-employment tax. Of that amount, the individual can contribute 20% as an employer contribution. Keeping in mind, of course, that the sum of all the contributions that are made to the plan, whether it's employee, employer, and or voluntary after tax, cannot exceed the overall limit. For 2023, that overall limit is $66,000 or $73,500 if they're 50 or older. For 2024, the limit was increased to $69,000 or $76,500 if you're 50 or older. So contrast this employer contribution rules or limit with the employee contribution limit. With the employee limit applies at the employee level, which means that the employee has to aggregate all contributions made to other plans that the individual might be participating in, like a day job plan, to determine whether they met that employee limit. Whereas with regards to the employer contribution limit, that limit applies at the employer level. That means that the ability to contribute to the solo 401k is not impacted by contributions made to another plan, like the day job plan. So even though the individual might have maxed out contributions to their day job plan, they could still make solo 401k contributions based on their self-employment compensation. Now, one exception to this general rule that the employer contribution limit is not impacted by contributions made to another plan sponsored by an unrelated employer, like the day job plan, would be the 403B exception. So if the individual is making contributions to a 403B, or if contributions are being made on their behalf, like employer contributions to the 403B, the sum of all those 403B contributions, the employee plus the employer, if any, together with any contributions that they would want to make to the solo 401k, cannot exceed the overall limit. Now, thanks to Secure Act 2.0 that was enacted at the end of 2022, now our plan would allow for employer contributions, non-elective contributions, profit-sharing contributions, they're all the same, referring to the same type of contribution, can be made as Roth contributions. What's interesting, based on our experience, our client feedback, is that many of our clients are not choosing to make employer contributions as Roth contributions. And that's because the plan already allowed for mega backdoor Roth contributions. So most clients are declining to make employer contributions as Roth contributions and instead just choosing to make voluntary after-tax contributions, which can then be transferred to either the Roth Solo 401k or Roth IRA. So why is that? Well, one is that the voluntary after-tax solo 401k contribution limit is 100% of the self-employment compensation, whereas as we just saw, the employer contribution limit is a percentage, right? It's 20% of self-employment compensation for a self-employed business tax as a partnership. So effectively, that means that the individual doesn't need as much self-employment compensation to justify the contribution that they want to make. At the same time, the deadline to make both employer and voluntary after-tax is the same. So there's no advantage of making the contributions as employer contributions. Finally, one has more flexibility when it comes to voluntary after-tax contributions. So what I mean by that is that if you have a plan like ours that allows it, those voluntary after-tax solo 401k contributions could be transferred out of the plan to a Roth IRA. And there's no triggering event that has to be met. Whereas if the individual had made employer contributions as Roth contributions, they would first have to meet a triggering event before they could transfer the funds out of the solo 401k to a Roth IRA. So if the goal is to get the funds into a Roth IRA, clients would therefore prefer to make the contributions as after-tax contributions because there was no triggering event. They could just transfer the funds from the voluntary after-tax solo 401k sub-account to a Roth IRA. Now, if someone does still want to make employer Roth contributions, we've got a number of frequently asked questions, right? So number one, do I need to deposit those employer Roth contributions into a separate account? So the answer is no. They could go into the same Roth account that someone makes employee contributions. So of course, it still would need to go into a separate account versus pre-tax contributions, but you could have both employee and employer Roth contributions deposited into the same bank or brokerage account for the Roth solo 401k. What is the contribution limit? So as mentioned, it's the same limit that applies to employer contributions generally, right? For a self-employed business that is taxed as a partnership or a multi-member LLC taxed as a partnership, the contribution limit is going to be 20% of self-employment compensation. Lastly, how do I report employer contributions made as Roth contributions? Well, this was an open question for almost a year after the Secure Act 2.0 was enacted at the end of 2022. Because historically, employer contributions were always made as pre-tax contributions, as tax-deductible contributions. But since they were now allowed to be made as Roth contributions, the question became, okay, well, how do I report that, right? Because it needs to be a Roth contribution, meaning after tax. And so there was an open question. Almost a year later, the IRS answered that question in their guidance in IRS Notice 2024-2, where they clarified that Roth employer contributions would need to be reported as tax deductible, so like a pre-tax contribution on the employer's tax return, right, the Form 1065 for the year for which the contributions are made, but then reported as taxable to the employee for the year for which the contributions are deposited. So for example, you still might see individuals making 2023 contributions here in 2024 because the contribution deadline is the business tax return deadline, including any timely filed extension. So if they filed an extension for their 2023 1065, that would give them until September 15th of 2024 to make those employer contributions. So if the individual made employer Roth contributions for 2023, but in 2024, that would be tax deductible on the 2023 employer tax return. So it would reduce the taxes, reduce the income upon which the tax liability is calculated in 2023, but then it would be raised up and taxable to the employee for the year of the deposit. So in other words, the employee would have to report it, right? The solo 401k owner would have to report it on their 2024 1040. And that would be reported as taxable by issuing a Form 1099-R. So from a reporting perspective, it's no different than as if the individual had first made a pre-tax employer contribution and then immediately converted the funds from the pre-tax solo 401k account to the Roth solo 401k account. Now, the individual doesn't need to go through those steps of first depositing it into the pre-tax account before moving it to the Roth account. But from a reporting perspective, it would be no different. Now let's talk about the voluntary after-tax solo 401k contribution limit. So as mentioned, right, you always start with self-employment compensation. For a business's tax as a partnership, that means line 14 of the K-1 less 1/2 of the self-employment tax. So once you run that pre-calculation, you know what your self-employment compensation is. The voluntary after-tax solo 401k contribution limit is 100% of self-employment compensation, dollar for dollar, up to the overall limit, right? That's $66,000 for 2023, $69,000 for 2024. Now, you do need to keep in mind that overall limit. So the sum of any employee, employer, as well as after-tax solo 401k contributions cannot exceed that overall limit. Now, it's noteworthy that the limit doesn't go up if you're 50 or older, right? So if you're 50 or older, you're allowed to make a catch-up contribution of $7,500. So you wouldn't make that $7,500 catch-up contribution as an after-tax. It would have to be made as an employee contribution. But when you're aggregating contributions to determine how much you can contribute as an after-tax contribution, you can ignore that catch-up contribution. So ultimately, you can still get to the same place, right? So if the individual were to make a $69,000 after-tax contribution for 2024, and they're 50 or older, and they're eligible to make another $7,500 catch-up contribution, they wouldn't make it as an after-tax. They would make it either as a pre-tax employee or a Roth employee. So they're still ultimately able to contribute, assuming they have the self-employment compensation to justify it, $76,500. It's just that they wouldn't make that $7,500 catch-up contribution as an after-tax. Now, it's interesting that unlike the employee contribution limit, where that limit applies at the employee level, the voluntary after-tax contribution limit comes from a different section of the code, which means that it's not impacted by contributions made to another plan through an unrelated employer, like a day job 401k plan. So in other words, if the individual has maxed out their employee contributions, say to their day job 401k plan, and they have the self-employment compensation to justify it, that person could make a full $69,000 after-tax contribution to the solo 401k. Now, one exception to that general rule that you don't have to consider contributions made to a plan sponsored by an unrelated employer, again, is the 403b exception, right? So if the individual has made contributions to a 403b, or employer contributions are made to the 403b on their behalf, that individual would have to aggregate those 403b contributions, employee and employer, together with any contributions that they want to make to the solo 401k, and the aggregate, the total, cannot exceed the overall limit. Finally, it's noteworthy that just like the Roth contributions, where those contributions need to be deposited into a separate Roth solo 401k sub-account, likewise, voluntary after-tax solo 401k contributions need to be deposited into a separate sub-account. This is how individuals will end up with 3 different sub-accounts, right? They have pre-tax, Roth, and after-tax. Or if you have 2 participants, say like a husband and wife, then you'd end up with 6, right? Pre-tax, Roth, and after-tax for each participant. Okay, now that we've laid the foundation with the basics and now also understanding those solo 401k contribution limits, let's start to answer this question of how much income do I need to make in order to be able to maximize solo 401k contributions. So the first scenario we're going to talk about, right, because what that means, right, when we talk about maximizing the solo 401k is going to mean different things to different people, right? So the first scenario is, okay, I want to maximize my solo 401k contributions while keeping my self-employment income as low as possible. So here we're going to assume that the self-employed business, again, is taxed as a partnership, multi-member LLC taxed as a partnership with the income reported on the 1065. Let's assume it's just one participant who doesn't make contributions to another plan like a day job plan. This individual wants to contribute 100% of their self-employment compensation to the solo 401k, but again, keeping it as low as possible. So remember, self-employment compensation is line 14 of the K-1, less 1/2 of the self-employment tax. And this individual only wants to make employee contributions. So how much income would they need in order to be able to achieve their objective? So given that you have to do that pre-calculation of reducing line 14 of the K-1, we have to work backwards to figure out, okay, how much income would need to be reported on line 14 of the K-1 where it would result in my self-employment compensation being $23,000 if I'm under 50, or $30,500 if I'm 50 or older. Because remember, my goal is to contribute 100% of that self-employment compensation to the solo 401k. So if I'm under 50, I would need $24,749 reported on line 14 of my K-1. I would then reduce that by 1/2 of the self-employment tax. That would give me $23,000. I could then contribute 100% dollar for dollar as an employee contribution, a salary deferral. That can be made as a pre-tax contribution or as a Roth. Now, if I'm 50 or older and I need my self-employment compensation to equal $30,500, that means that line 14 of my K-1 would need to be $32,819. I would then run a pre-calculation to reduce that amount by 1/2 of the self-employment tax. That would give me $30,500. And since I'm 50 or older, I can contribute 100% of that for 2024 as an employee contribution, either into my pre-tax solo 401k account, my Roth solo 401k account, or a mixture between the two. Since I've maxed out, I've contributed all my self-employment compensation as an employee contribution. In both cases, that means I'm not going to be able to make any more pre-tax employer, Roth employer. I'm not going to be able to make any more voluntary after-tax contributions to the solo 401k. Now let's talk about a different scenario. Similar concept. I want to maximize solo 401k contributions while keeping my self-employment income low, right? The first scenario was to keep it as low as possible. Here, I still want to keep it low, but now I'm willing to make not only employee, but also employer contributions, right? So, but otherwise, same scenario, right? Self-employed business tax as a partnership, one participant. I'm not making contributions to a day job plan. So here, I need my self-employment. If I'm under 50, I need my self-employment compensation to equal $28,749. That would allow me to contribute 100% up to $23,000 as an employee, either pre-tax or Roth. I could then contribute 20% of that same amount, which is $5,749 as an employer. So between employee and employer, I'm contributing all of that to the solo 401k. So how much line 14 K-1 income do I need to result in my self-employment compensation equaling $28,749? Well, I need $30,935 reported on line 14 of the K-1. I then reduce that by 1/2 of the self-employment tax. That would give me $28,749 in self-employment compensation, which I could then contribute it all between an employee and employer to the solo 401k. Now, if I'm 50 or older, I would need $38,125 of self-employment compensation. That would allow me to contribute $30,500 as an employee, including my $7,500 catch-up, plus another 20% of that self-employment compensation figure, which is $7,624 as an employer contribution. So between the two, employee and employer, I would contribute 100%, $38,124 to the solo 401k. So how much income would I need to report on line 14 of my K-1 in order to have that much self-employment compensation? Well, the answer is $41,023. When I reduce that by 1/2 of the self-employment tax, that gives me $38,124, which I could then contribute all of it to the solo 401k between employee and employer contributions. So now let's shift and talk about a different scenario, right? Because maximizing my solo 401k contributions means different things to different people. So now let's talk about someone who's not interested so much in keeping their self-employment compensation as low as possible or even low. Here, this person just wants to maximize the pre-tax solo 401k contributions, wants to maximize the income tax reduction benefit across employee and employer. Again, otherwise assuming the same assumptions. Business tax is a partnership, one participant, doesn't make contributions to a day job plan. So this individual would need $230,000 of self-employment compensation. If they're under 50, that would allow this person to contribute $23,000 as a pre-tax employee, 20% of the same amount, or $46,000 as a pre-tax employer. So between the two, now they've made a $69,000 pre-tax solo 401k contribution for 2024. If that person is 50 or older, with that same amount of self-employment compensation, they would be able to contribute $30,500 as a pre-tax employee, and then another 20% or $46,000 as a pre-tax employer, so that the sum of pre-tax solo 401k contributions would be $76,500. So the question becomes, how much income would I need to report on line 14 of my K-1 so that my self-employment compensation is equal to $230,000? And the answer is $243,717. When you reduce that amount by 1/2 of the self-employment tax, that gives you $230,000, and then the individual is going to be able to maximize those pre-tax solo 401k contributions. So now let's go to the other spectrum, right? Let's assume that the person wants to maximize Roth solo 401k contributions. This could be Roth employee or voluntary after tax, in other words, mega backdoor Roth. We're going to assume, right, that the individual is not making employer contributions as Roth contributions, because we talked about the different reasons earlier why, in our experience, for clients like ours that already have the ability to make mega backdoor Roth contributions, they've just been choosing to make Roth employer contributions. But otherwise, same scenario, right? Business tax as a partnership, one participant doesn't make contributions to a day job plan. So here, this person if they're under 50, they would need to have $69,000. One second here. Let's get this cleaned up real quick. Thank you so much. Oh, 1 second. Thank you so much for your patience. If you do have questions or topics you wish to discuss, please don't hesitate to chat those over, as we'll go through those at the end after we get through these slides. Okay, wonderful. And I see we got a question, so thank you so much for bringing that question. We're going to get to that here shortly. So this person, right, wants to maximize Roth solo 401k contributions. For 2024, they would need $69,000 of self-employment compensation if they're 50 or older. Or I'm sorry, if they're under 50. So if they're under 50, they would need $69,000 of self-employment compensation. That means that they would be able to contribute $23,000 for 2024 as a Roth employee, and then they're going to be able to contribute the difference up to $69,000 as an after-tax, which could then be moved from that after-tax solo 401k sub-account to their Roth solo 401k. So in order for that person to end up with $69,000 of self-employment compensation, they would need to have $74,246 reported on line 14 of their K-1. If they're 50 or older, they would need $76,500 of self-employment compensation, which means they can contribute $30,500 as a Roth employee, and then another $46,000 as a voluntary after-tax, which could then be moved to their Roth solo 401k. So they end up with $76,500 in their Roth solo 401k account. So in order to have $76,500 of self-employment compensation, they would need to report $82,316 on line 14 of their K-1. All right, that takes us to the end of the scenarios that we wanted to discuss. Let's just spend a couple minutes on the tax credit. So our plan is eligible. It makes the self-employed person eligible to claim a $1,500 tax credit. So under the Secure Act, the Congress authorized a number of different tax credits to encourage businesses to offer a 401k plan. One of those tax credits is a startup cost credit, which is only available to businesses that have non-owner employees. So, which of course would preclude a solo 401k, because in order to have a solo 401k, you can't have any non-owner full-time W-2 employees. But another credit that was authorized under the Secure Act is the automatic participation credit, which clearly under the section of the code, clearly under the IRS instructions that to the form that the individual would use to claim the credit, doesn't require that the person have non-owner employees. So this means that a self-employed person that sets up a solo 401k plan that includes the automatic participation feature would be eligible to claim the credit. again, $500 per year for 3 consecutive years. It would be both for new or existing plans. So if someone has, say, a solo 401k at Vanguard or Fidelity or Schwab, and they want to upgrade it to our plan, so now that they would be eligible to make mega backdoor Roth contributions or invest in alternative investments or take a 401k loan, well, they're also going to be eligible for the tax credit, which is going to more than offset the cost to set up a plan with us over the first 7 years. The net cost is going to be $0. So if you are setting up a new plan in 2024, the individual will be able to start claiming the $500 credit when they file their 2024 taxes. If you upgrade an existing plan in 2024, the individual will be able to start claiming the credit when they file their 2024 taxes. So it's going to, again, more than offset the cost. Our fees are $650, which includes the $525 establishment fee, plus the first $125 annual fee. On the anniversary date, so say this time next year, we would charge our $125 annual fee that covers the second year. So the credit is not a function of the cost. So the net cost in the first year is $150. The net cost in the second year is negative dollars, right? Because it's more than our fee. But that's fine. The individual would still be able to claim the full $500 credit for each year. And this is a tax credit as opposed to a tax deduction. With a tax deduction, the individual is reducing their income upon which their tax liability is calculated, whereas with the tax credit, the individual is able to reduce their tax liability dollar for dollar. So in that way, a tax credit is much more preferable than a tax deduction. So again, you just have to be eligible to set up a plan, have a plan like ours that includes the automatic contribution feature. The automatic contribution feature is setting a default 3% contribution percentage, but the solo 401k owner, as the employee, under the rules, has to be given the option of opting out of the default amount. So that would enable the solo 401k owner to contribute more, contribute less, or even contribute nothing, but they would still be eligible to claim the credit. But they're just simply exercising their rights under that automatic participation feature. So again, if you have an existing plan, it can be upgraded to our plan, so the individual would be eligible to claim the credit. You claim the credit by filing Form 8881. We have deep dive walkthroughs to walk through our clients exactly, okay, the first step is filing 8881, and then here's how you report it on the taxes. It's of course going to vary depending on whether their business is taxed as an S corp versus a sole prop. But we of course make those deep dive walkthroughs, those video webinars, available to all of our clients whose plan includes the automatic participation feature. So Lindsay is self-employed. She already has a solo 401k plan. If she amends her plan to include the automatic contribution feature in 2024, she'd be able to claim the $500 credit when she files her 2024 taxes. And then again, for 2 more years, as long as she continues to maintain the plan with that auto contribution feature. Whereas Brad, who's eligible to set up a solo 401k because he's an attorney, self-employed, no employees working for him, if he signs up in 2024, he would be able to claim the $500 tax credit when he files his 2024 taxes. And then again, for 2 more years, as long as he continues to maintain the plan with the automatic contribution feature. Okay, thank you so much for all the great participation. And the good questions. Let's start to go through those. I have a question. I'm less than 50 years old and I take $69,000 salary from my S corp. Assume I'm only making after-tax contributions. Can I go ahead and make the $69,000 as my after-tax contribution? Definitely, right? If that's the only type of contribution that you make, you have a plan like ours that allows for after-tax contributions. Those contributions go into a separate after-tax account before they get moved to the Roth solo 401k. Now, if you go to our YouTube channel, you can easily find recently we did a deep dive webinar specifically geared towards how much income I would need in order to maximize contributions for a business that's taxed as an S corp. What custodian do you use for the self-directed solo 401k? Well, we're neutral as far as where the accounts are at. We help our clients open up accounts at hundreds of different banks, many different brokerages, and we help them open up those accounts. In other words, we would pre-fill the paperwork. say to open up the accounts at Schwab or Fidelity, etc. Ultimately, what's most important from a solo 401k perspective is that the accounts are opened up under the name and the EIN number of the plan. So as part of the onboarding process, we're obtaining an EIN number specifically for the plan. Most definitely Fidelity, right? That's one of the top options where we pre-fill the paperwork to open up free brokerage accounts at Fidelity. Free meaning Fidelity doesn't charge anything to set it up. There's free online trading. There's no maintenance fee. So we would prepare all the paperwork. If you're going to have different types of contributions like pre-tax versus Roth versus after tax, we would ask you in the onboarding process, what type of contributions you're looking to make so we can prepare the requisite number of account paperwork packets. Hopefully that makes sense. Thank you so much for the good question. Yes, it could be Edward Jones. So typically with Edward Jones, the individual is working with their advisor. So we've had many people open up accounts at Edward Jones. So we would guide you through the process. A lot of times the advisor, based on experience, will handle opening up the accounts, but we could guide them to do it correctly, right? We would get the EIN number, the requisite number of sub-accounts, etc. Does a cash balance plan alter the percentage of pre-tax employer contribution? Well, it doesn't limit how much the individual can contribute to the solo 401k, but if the individual contributes more than 6% of their self-employment compensation as an employer contribution. Remember, we talked about the limit, the overall limit's 20%. But if the individual has a defined benefit plan and they want to preserve the ability to maximize contributions to the defined benefit plan, then they wouldn't be able to contribute more than 6% of their self-employment compensation to the solo 401k. So it's not that it limits the solo 401k, how much you can contribute to the solo 401k, but it could limit how much you can contribute to the defined benefit plan. Now, it's noteworthy that maxing out employee contributions, maxing out the voluntary after-tax contributions to the solo 401k is not going to limit how much the individual could contribute to the defined benefit plan. Yes, Fidelity. Yes, the self-employed business would be the TPA. Now, we are the solo 401k plan provider, and we provide all the ongoing compliance support, but we don't have that level of access and control, for example, over the accounts. So we wouldn't technically be the TPA, but we are providing those administrative ongoing compliance support services for the solo 401k, whether it's just the mandatory plan updates and amendments that we handle automatically, or whether we're handling the 5500EZ or the 1099R, et cetera, et cetera. Good questions. Yes, and we talked about that. Yes, we do work with Edward Jones, most definitely. So Edward Jones, it's confusing out there because a lot of these institutions, whether it's Edward Jones, whether it's Fidelity, whether it's Schwab, they'll offer their own solo 401k plan, which means it's their plan documents, but they're also providing the accounts. But at the same time, they will still open up accounts for a third-party plan. So what the individual can do with their solo 401k is going to depend on what those plan documents allow. So Edward Jones's plan doesn't allow for after-tax contributions. It doesn't allow for loans, right, based on experience and client feedback. Likewise, Fidelity plan doesn't allow for Roth, doesn't allow for after-tax, doesn't allow for loans, meaning the Fidelity document that governs the account. But you can get the documents through a third party like us, right? With all the ongoing compliance support and the expertise and education as far as what you want to do, right? Whether it's after tax or Roth or loans, et cetera, but still have the accounts at the financial institution of choice, like Edward Jones, like Fidelity, whatever the case may be. Hopefully that makes sense. So there's no obligation to report voluntary after-tax solo 401k contributions. As a matter of fact, if your business is taxed as a partnership or a sole proprietorship, There's not even the option to do that because it's an after-tax contribution. If your business is taxed as an S corp, you have the option to do it, but it's still optional per those W-2 instructions. Now, the subsequent transfer, though, so when you're making that after-tax contribution, it needs to go into a separate voluntary after-tax solo 401k sub-account. And then the funds are moved to either a Roth solo 401k or Roth IRA so that you have the potential for tax-free growth. So that it's a two-step process, right? Contribution, then move. So the move is reportable on a Form 1099-R. And we handle that as an optional free service. In other words, no additional charge for our clients. We have an online form that clients use to let us know about that after-tax to Roth transfer. They can use it 24/7 to get the information in the queue for us to be able to prepare that 1099-R for their plan. Hopefully that makes sense. Thank you for the great questions, and thank you for the good participation. We have another few minutes. If there are more questions, we would urge you to continue to participate on our community, in our forums, in our daily webinars, on our YouTube channel, right? We'll be back on Friday with our deep dive session regarding solo 401k loans, A to Z. So we just really appreciate the opportunity to, answer questions and help educate folks about these solo 401k plans. Yeah, for a sole proprietorship, it's just like the partnership, right? There's no even way to report the after-tax contribution, but the subsequent transfer from the after-tax solo 401k account to the Roth solo 401k or Roth IRA would be reportable. All right, we'll take it from there. Thank you so much, everyone. All the best.